just mute the YouTube sound here. Okay, looks like we are live, everybody. Perfect. There's a few eyeballs already, so I know I'm going at the right place here. Thank you so much for joining me. This is episode 27 of the Volatility Barometer, and I've prepared two topics today. Hopefully people find some value in what we're going to go over. I think I've got this list of all the segments that I've been planning for this show. I'd like to turn it into some type of entertainment show. And what I'm going to do over the next month or two is I'm just going to pick a couple of them and try to cycle through as many as possible and give everybody a couple of them, see how you feel. You can leave comments and feedback. Let me know if you liked the segment, if you didn't, maybe what I could improve on. And just give your feedback. Always feel free to leave comments. I respond to all comments on YouTube. So, even if they're not so pleasant, which sometimes does happen, but I do respond to all comments anyway. And so please leave me your feedback. But we've got a couple of them to get to today. I think they might run a little long, so I'm just going to get right into things here. But first of all, we're going to go for the data corner. We're going to talk about VXX Decay factor. The reason this is coming up is because in my last live stream, hold on, let me just stop the intro music. In my last live stream, we actually talked about broken wing butterflies and how to scale them correctly to your portfolio size. So that would be this one right here, episode 26. We talked about, personally, I oftentimes do a 1% allocation, and people were wondering how I actually go about sizing those. So you can watch that one first. But today, natural follow-up question to how you size broken wing butterflies is, how are you exactly choosing the strikes as well? So that's where the decay factor of VXX comes in. How much is it going to decay over the time period that we're planning our trade for? And we can get a pretty good idea of the outcome. And of course, you always want to be as data-driven as possible. So we're going to go over all of that. I think people will find it valuable. And then we're going to do one from the Mastery series, which I haven't done yet, but it's just going to be me talking about things that I think might help people. Sometimes it's going to be investing related. Sometimes it's going to be career and whatnot. So we'll give it a shot and you can leave some feedback there. But we might go a little late, so let's just get into the intro and dive right into things. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so as always, if you would do me the favor, give the video a thumbs up for me if you would be so kind. I noticed that there is a thumbs down already. I thought it was kind of funny. As soon as I prepared my live stream and I uploaded it, within about 10 seconds, there was a thumbs down. So that's fine too. If you don't like me, you can give it a thumbs down. I wonder why you're here if you don't like me, but the YouTube algorithm doesn't really differentiate between thumbs up and thumbs down. It's basically counted as an engagement. So if you do want to give me a thumbs down, feel free to do that as well. But thank you very much for joining me. Let's get right into what we are talking about with VXX Decay. So like I mentioned, The reason that this topic is coming up today is because our last live stream, I basically was showing people how to size a broken wing butterfly. This is one of my favorite trades to take. I love broken wing butterflies, especially on volatility ETPs. I think they're fantastic. They have a really good risk-reward profile. But the question was, of course, in my email was just filled up, how exactly are we choosing these strikes? So there is actually a lot more to it than me just telling you a very simple aspect. But maybe over the next several months, we can go through this one at a time and we can actually give you a better idea. But of course, the current VXX decay factor is going to weigh fairly large in my decision on where I'm going to set those VXX strikes. But there's other things as well, the positioning of the portfolio. For example, if this trade did go badly, I would like to know that over here with the VXX, there are actually some things offsetting that. So as I've pointed out many times when I do these live streams, I am mostly net long, net short vol when volatility is in the mid to low ranges, which is currently right now. We've had a lot of trades that have just been shooting higher for the last 5 or 6 weeks. So the positioning of the portfolio does actually factor into where I'm going to be setting these strikes. Some other things to think about would be the size of the trade. Of course, if it's a really large trade, you'd want to be more conservative with it. If it's a very small trade, well, then it might be okay to get a little bit more aggressive. That's a factor as well. The current volatility environment. Has the VXX been decaying a lot recently? Is it down here, or is it coming off of a high? That makes a huge difference with how much potential decay factor we can expect. So that would be one factor. There's many of these. How much can I lose? How much can the broad portfolio absorb? Sometimes I actually might set up a trade that is not intentionally set up to lose money, but with the stated purpose that I don't really care if it makes or loses as long as it's offsetting something that I'm doing in the portfolio. So the general point is there is actually quite a few aspects going into this. But what we're going to talk about is the first aspect, the VXX decay factor. Let me just circle back for 1 second, make sure nobody's screaming at me about the volume. We're all good. Okay, so with respect to the VXX decay factor, we've gone through these numbers in a previous live stream where you can actually just do a simple regression and you can basically determine how much the VXX decays on a 1 day, 1 week, 1 month basis. This is very easy to calculate. So and of course you can do that on UVXY, you can do that here, you can do it on the old TVIX, that's here. We know the decay factor of all of these VXX, all these volatility ETPs. But the point is that on a long-term geometric compounding scale, it decays minus 0.238% per day. But that is a very average long-term number that may or may not be valuable to you. If we are in a very high volatility environment, it's certainly going to decay much less than that. It would probably be positive. If we're in a very high contango situation where maybe the VIX futures are just screaming a short vol trade at all of us, then perhaps it would actually be decaying a lot faster than it normally does. This is a long-term geometric regression of the VXX. So what we can actually do, and what I do for the VTS community, I don't ever speak with my live streams that, you have to join or anything, but we have one of my custom-made metrics called the VXX crush level, which is essentially telling us on that specific day, based on where all the volatility metrics are lying, and essentially where the M1, M2 futures compared to the VIX, how many days to expiration are left in the cycle, we can determine exactly how much we can expect over the next 1 day, how much the VXX will decay. Now, if you're curious where I'm coming up with this, if you go on the website and you go to the article section, article 578, there is an explanation of this metric. I go through a little bit of the math behind it. You can see some formulas and sort of piece it together if you'd like more information on this. But the general point is we can actually determine with pretty reasonable accuracy how much we can expect it to decay on a one-term basis. So then we can take that number and we can actually divide it ourselves and determine where we are currently at in the cycle. So this is just dividing the VXX crush level into decile, or into 5 equal sections. So 0 to 20, 20 to 40, which is kind of where we are right now. You can see that as of last Friday, we were the 32.6 percentile. So we're kind of sitting here. And we can expect a daily decay of minus 0.51% in that range, but more specifically, exactly minus 0.54%, because we're actually a little bit higher than that. Minus 0.54%. That's a very important number, right? Because it's very, very different over different time periods. You need to know what to expect now, not what to expect in all market environments. We need to know today. So if we take my current trade as just a rough example, you can see this trade expires November 26th, which is 5 days from now, but there is a holiday next week. It is Thanksgiving. So it's a 4-day cycle. We can actually determine what this trade is going to look like on average 4 days from now. All right, that's the point of this metric, is that we can do it on a 1-day basis. Now, you might be thinking, just point this out really quickly, because it is very important to understand this. You'll notice that the long-term median is minus 0.38%, but I said the long-term geometric regression is actually minus 0.238%. It's a little bit different there. The VXX decay is seemingly a little bit faster day to day, just a little bit, than the long-term regression. And this gets back to the heart of something that I talk about an awful lot here. I like to remind people as often as I can that losses are more costly to a fund than gains are beneficial. And what this means is, compounded geometrically over time, when the VXX goes through those very difficult periods and it suffers massive spikes, it's actually taking a lot longer to recover from those than a simple arithmetic 1-day regression. So if you suffer those drawdowns, it actually takes a lot longer to get back to break even. For example, if you have a 50% drawdown, well, it could take you a full 100% subsequent rate of return just to get back to break even. This chart is essentially why the difference between the daily regression on a long-term scale, compounded geometrically, versus what we are more interested in as traders, what's most likely to happen on Monday. That's what this value is basically showing us. And again, I do like to point this out to people as often as I possibly can, that this is one of those unfortunate realities of the trading world that you will encounter out there. Because the mathematical fact is, the more aggressive you trade, the larger the drawdowns you suffer, the lower your edge will be. Your long-term performance will start to suffer if you are trading too aggressively. This is not my opinion. This is a mathematical fact. It is the same thing as losses are more costly. Compounded geometrically, drawdowns are really going to hurt you. So that needs to be the top priority, to reduce those. It is the exact inverse as far as popularity and eyeballs. So if you go online, what actually gets the most eyeballs is when you just make outlandish claims, when you just talk about extreme performance. We're going to make 100% a year, guys. It's going to be so easy. We're going to sell naked calls and it's going to be awesome. That type of thing gets a lot of eyeballs, but is an exact inverse of what actually works. So this is why people sometimes suffer 5 or 10 years or maybe longer. This social media experiment we're going through is fairly new. But 10 years from now, people will be in the exact same position they are now with the size of their portfolio, because they just end up spinning their wheels. They follow one person online who said that they made 100% a year. They follow for a little while. Oh, that didn't work at all. I lost all my money. Now back to square one. Go find somebody else who's lying about their performance. Oh, that guy makes 200% a year. Let's follow that guy. Well, nope, ran into a buzzsaw there as well. Lost my money. Back to square one. You can continue doing this over and over again. So it's one of those unfortunate realities that what actually works mathematically is the last thing that you will encounter online. That doesn't get eyeballs. When you see people talking about these insane rates of return, knowing that even the smartest people on Wall Street are getting mid-single digits, for some reason there's a bunch of people on Twitter talking about how easy it is to make 100% a year. If you see people doing that, you turn it off. If you see other people talking about safety and trading conservatively and managing drawdowns, sure, you might need some smelling salts to stay awake when you're listening, because that's boring stuff, but that's what leads to the promised land of everybody having, a great retirement fund. So just be aware of that. Little bit of a side tangent there. It is a mathematical fact that if you are trading too aggressively, you are going to start eroding your edge. So anyway, back to the analysis here. Like I said, we can check out this current trade that we have open. This is the live trade in the VTS community. We've got 4 trading days to go. The VXX is currently at 2096, and it is currently decaying at 0.54% per day. So that only applies to Monday. I will readjust all the metrics on Monday, and we'll decide what is most likely to happen on Tuesday. But with just those numbers, we can actually go down and we can input minus 0.54 and 2096, where the VXX currently is. Let me update this formula. Apologies, it's going to beach ball a little bit here. My spreadsheets are just getting way too large. I have to transfer all the data elsewhere. So give it a second here. But we can actually see 4 days from now, I'm roughly expecting the VXX to be 2051. Remember, that includes the holiday. So if the VXX just does exactly what it is doing, this is not a personal prediction. This is just going by the numbers. Most likely tomorrow will look like today. There's no reason to be a contrarian in this type of market. Just what happened yesterday will probably mirror today within, say, a standard deviation. So this is about where I would expect my trade to be next Friday. VXX 2051, profitable trade. It's going to be fine. If it decays a little bit faster, that would be even better. If it decays a little bit slower, still going to make a nice profit. So more than likely, this is going to be a pretty decent trade. I could close it now, but the point is that we can actually determine these things mathematically. We don't have to guess. I'm certainly not guessing with my investing. I'm calculating everything to be the most probable situation going forward. So if we wanted to go through another example, let's say somebody wanted to do today. You're not in the VTS community, but you want to do a fresh trade today. This contract with 27 days to go, remember there are weekends and there is 1 vacation day, so that's actually 19 trading days. Let's try to price out a broken wing butterfly for 19 trading days from now. Where should we set our strike? It's fairly random. There's a lot of strikes there. What should we do? Well, if we use what I'm looking at here, I can basically go down to 19 days from now. I'm expecting, if the VXX decays at the same rate that it is currently decaying as of last Friday, 19 trading days from now, I'm expecting it to be 1891. That would be a pretty good forward estimation of where it'll be. So let's try to center a trade around this 19 strike and see what that looks like. So it's a broken wing butterfly. So remember, we're going to break that lower wing and make it look like this. This is what the trade looks like. And remember, 1891, we're expecting it to go about there, 19 trading days from now. So this appears to be a very good trade. If what happens goes based on the actual statistics, that would be a good trade. We can also do a little bit further. This is the break-even point. Well, the break-even point is at 1793. Well, how fast would the VXX have to decay before I start getting into trouble? The break-even point. Here it is in the lowest percentile range. That's the 0 to 20, the fastest the VXX decays. If it decays even faster than it is now and it jumps from this column to this column, it could actually get to that 1796 level, which is right about there. So this trade, being that the VXX is all the way over here, it could actually get to that break-even point if it starts decaying in the top 20% of speed. What about the maximum loss? This is what I'm concerned about with my portfolio. Break-even, I don't care. Remember, my portfolio is net long equities, net short vol. So I actually do want the VXX to go this way. I want it to move into my range. But what if it goes to 17? Then this trade's going to be a max loss. So let me do a little quick side tangent and brush up on what we talked about in that previous decay factor video that I showed you. I'm going to price this based on my portfolio, and typically I do a 1%. So all I'm going to have to do here is 274,842 times 0.01. Apologies, this is very slow, but I want people to be able to see it. So I want to have a maximum loss on this trade of 27.48. But I can basically just glance at the premium here. It's $6 on a $100 contract. That video told you all about how to do this in your head. It's very easy. You can just divide by 94 and you can get the contracts of 29. So based on my portfolio size, I would open 29 of these. Now, I don't actually want to lose $2,700 on this trade. But if I did, if the VXX went from here all the way over here, which again would be a decay factor far extreme. It would be probably something touching, down here over the -1 range. If that were to happen, well, so be it, because the rest of my portfolio would profit far more than the 2,700. But this is how you can start trying to understand where your pricing is going to hit on these important key levels. Again, statistically speaking, this trade looks pretty decent. Now you might think, well, let's do another one just because remember I said the current volatility environment. We're actually in an environment where the VXX has been decaying reasonably quickly for the last 5 or so weeks. So you might think that it might fizzle out. I mean, that doesn't necessarily have to happen. The VXX can do whatever it does. It could start decaying extremely fast for all we know. But statistically speaking, it is less and less likely to be decaying going forward at the same speed. So you might actually want to open a slightly more aggressive trade. Instead of the 19, you can just check out this 20. And again, we'll do the broken wing butterfly. Close that one. And it's going to look like this. So it's a slightly more aggressive trade. First of all, I'm going to price it out. So just so it all looks the same. I think I said about 27.30 divided by, now this is a 27-cent credit. So this one is actually going to be $73, which I can open 37 contracts of this one because it is a slightly more aggressive trade. There's the same max loss of 2,700, but this is a different trade now. You can see the difference between the two. This one, on the high side, if the VXX stays where it is or spikes up, here's the VXX right now, this trade can actually make $1,000 on the high side, whereas this one, more conservative trade, can only make 174. On the maximum gain for the conservative trade, it can make 2,900, but the aggressive trade, if we do get lucky, can actually make $4,700. Same max loss, but one of these is more aggressive. And the reason is, remember I said, in order for this trade to get into trouble, it has to actually hit here, which based on long-term averages, because we like to calculate everything, we don't leave anything to chance, we know that it would actually have to decay pretty fast in order to see that trade start losing money. However, the other trade starts to lose money back here at 1873. 1873 is right around this column, pretty close to the 19. So actually, this is a more aggressive trade. It is more likely that the VXX will start knocking on over here and potentially put the portfolio not in jeopardy because we've priced it correctly, but this trade could actually lose money. Now, again, just as a reminder, the rest of the portfolio would make far more than this loses, but so it doesn't overly matter that much. But the point is, strike selection changes the risk-reward profile of these trades. You have to be able to understand that the options market is very efficient, so there's really no edge in doing anything blindly. All of those strikes can be viewed as equivalent. You could open a $15 centered broken wing butterfly and a 25 call broken wing butterfly, and on a very long-term time horizon, it would work out the same profit, more or less, with no edge at all, just churning everything month to month with no edge applied to it whatsoever. You can expect that the ones that are conservative, you might win 9 out of 10, but the one that loses money might lose a lot. The ones that are aggressive, well, they're not going to win as much, but when they do, they're going to win more money. And long term, because of the efficiency of the market, it is actually kind of a wash, churning. But what we do, of course, is we apply an edge. And calculating things, understanding that the VXX decays long-term 0.238% per day on a long-term geometric regression, that is important data to have. Understanding where it decays today, next Monday, that's an important edge to have. People that I'm competing against in the options market, do they know that? Maybe, maybe not. How many people actually go through these numbers and actually know, can say with certainty, based on where the VIX futures are, based on the fact that the M1, M2 futures and the VX30 contract compared to the VXX or the VIX index at expiration, I can tell you with certainty that if nothing happens on Monday, if everything stays sort of the same as it was last Friday, the VXX should be down 0.54%. This is an edge. Understanding how to price these out. This is an edge. Knowing whether to go for this one or knowing whether to go for this one, that's an edge. Knowing that 1% is the right size compared to all the other positions that I have on, that's an edge. Understanding that, if it goes down here, I have to know how much the rest of my portfolio is going to make or lose. All of these things are additional edges. So apologies that it's not a super straightforward, here's why I chose that strike. Today's presentation was essentially just the first aspect of we have to know how much these products decay. One of the things that bothers me, among many things, of course, if you follow me, I am very bothered by social media. But one of the things that bothers me a lot is all of these experts that talk about volatility. Are they? Because it all sounds very abstract. It all sounds like it's guesswork. Of course, the numbers they report are phenomenal, right? But most of them don't even know how much the VXX decays on a day-to-day basis, let alone how to actually structure a portfolio. So it is a little bit of a pet peeve of mine. But if you who are watching my streams, I would encourage everybody to calculate everything. It doesn't mean that you have to use it and be just a robot. If you want to be a little bit discretionary, that's fine. My options trading is sometimes a little bit discretionary. My systematic ETF strategies are all completely systematic. They are not discretionary. But you have to start with the data. So this is just an example of some of the quick things that I go through. Of course, there's many more. I can't do it all in a quick live stream. But yes, that's what I am expecting. So the trade that we have open currently, I am expecting that based on all of what we understand about the VXX, this trade is looking pretty good. The likelihood that it goes back down to here is extremely low. It's actually more likely to just make the standard $500 than it is to actually start losing money. But more than that, because that's just one winning trade, I also have to do this for the next 30 years successfully in order to really make an impact on my portfolio. And that's why I go through quite a large amount of data and calculating exactly what I am expecting to happen. So hopefully people saw the little exercise here. I tried to make it as simple as possible. My calculations are far more complicated than that, but it's a good starting point for all of you. So get your data, go back to 2004, get all your ETF data, watch my videos, my live streams, understand what I'm talking about when I say the VX30 contract and how that relates to the VIX futures and the volatility ETPs. You need to know all of this stuff. The options market is a highly competitive place, and if you don't know these things, it is going to be difficult. It would be like trying to play basketball in the NBA and you don't know how to dribble. It's just, probably not going to work out very well. So, yeah, that's the first part. So, VXX decay factor. Very, very important stuff. The second point, and leave some feedback on that data corner. Essentially what I view this as is I'm going to present a piece of data, which would today be the VXX decay factor of 0.54% on Monday. And more than that, how it relates to actual trading. Giving you data is one thing, but actually telling you how I use that data and how you could potentially use it, that's what that series is going to be about. So leave some feedback on data corner. Let's move on to Mastery series. This is one that I get a lot of questions about this. You might be thinking, well, why is he talking about stuff that isn't investing related? Well, I actually get an enormous amount of emails from people. Typically, I would say young men, but I don't want to specifically box everybody into that. But I do get a lot of people reaching out for advice. They see my live streams. They see I run a business. Hopefully I seem to be a fairly happy person. People are asking me, well, how did you set up your life this way? How did you get to where you are? How do I do that? How do I choose a career? How do I make sure that what I do isn't a waste of time? All of these things. So, of course, I am talking to young men today, but I'm also talking to everybody because it is never too late to change careers. You might be thinking, well, I'm 50 years old. How does this relate to me? It relates to all of us. I'm on my second career. I started, from age 15 to age 30. I was golfing 10 hours a day. I went from being a straight beginner when I was 15 years old to playing professionally and traveling around the world and playing tournaments. And when it was time to retire from that career, I'm in that position. Well, look, I'm in my 30s now, and I have no direction. What am I supposed to do? How am I supposed to go for the next stage in my career? So even if you're 50 or 60 years old, it is never too late. I know people who are on their third career change, and they can do it very successfully. Obviously, it's going to be work, right? What is that old saying that, what does success look like? It's dressed in overalls and it looks like work, right? It's going to be difficult. I'm not saying that this is easy. I'm not sure if you've ever read the book, but the Malcolm Gladwell's book, The Outliers, he was talking about the 10,000 hours and how in order to master something, you need to put in 10,000 hours of work. Well, if you calculate 10,000 hours, and if we just take that as a rough ballpark estimate, I largely agree. Obviously, after 5,000 hours, you're going to be quite proficient at it. Getting to a master or not, who knows, but 10,000 hours. Well, if you work 8 to 10 hours a day, that's 3 years. You can be a master at anything in 3 years. And if you have another job currently and you have to do this 5-6 hours a day on the weekends and then 3 hours in the evenings, well, then it might take you 5. But what I always tell people is 3 to 5 years, you can do anything. Now, some careers, of course, you can't be a doctor in 3 years. There is a certain level of education, but many, many careers out there you can. Well, how do you do it? All right, how do you structure this? So I wanted to do a little presentation. Again, hopefully people find value in this. But essentially, how do you find your perfect career path? This is something that people put very little thought into, surprisingly little thought into. And what ends up happening for most people, and I don't want to be grim here, but it is a reality, most people wake up and they're 40 or 50 years old and they realize they don't really like where they're at. They don't really like what they're doing. They don't like the money that they're making. They don't like the value that their careers is giving them. Whatever it is, you need to actually custom design what you're doing. So what I mean by that, and I'm sure at some point you've seen something like this, but I'm going to add a little bit of element of my own and relate it back to my own experience. So of course, the first thing that you will need is you need to just make a list of the things that you are either already proficient at or things that you could be proficient at that are suitable to your personality. This is very important. Obviously, being good at something is going to be the centerpiece of any success that you have down the road. If you're not good at it, or if you can't get good at it, if it just doesn't suit you, if you're terrible at math, you probably don't want to be an actuarial scientist. If, whatever it is, if you're a horrendous athlete, you just can't do anything right physically, that's fine. You can live a very wonderful life if you're a terrible athlete. But you probably shouldn't be a personal trainer if you're a terrible athlete. So proficiency is where it all begins. You have to either be good at it or something that suits you and you could get good at it. The second thing is, of course, you need to be passionate about it. It is nearly impossible to have a long-term sustainable career if you're not enjoying what you do. Now, of course, you might have heard the old saying that if you find a career that you enjoy, then you'll never work a day in your life. Frankly, I think that's kind of bullshit. It doesn't matter how much you like what you're doing. There's going to be struggles, but at the very least, you're going to need that passion or it's just a non-starter. Even if you have passion, it's still not enough, but it will push you through those difficult times. I love what I do, but there are still times when I struggle. I loved golfing, but there were times when it was hard and I had to force myself to get out on the golf course. So these two things, they really do go hand in hand. And unfortunately, not many people are in this situation. You can ask yourself right now as you're listening to me rant about this, are you currently in a career that A, you're good at, and B, that you're passionate about? My guess is that I have eliminated quite a few people who are listening right now. I would imagine one of those two, or maybe both of those two, don't apply to you. But we have to go further. You have to hit these two because you're not done yet. This is not going to lead to those, I don't want to make people compare to others or whatnot, but the dream career for you, these two are not enough. Obviously, it has to make money as well. Now with money, doesn't have to make $1 billion, of course, but it has to make some money. Because if you imagine the standard example, I'm sure your parents told you at some point, mine certainly did. We've heard it all in the movies. There is a way to be proficient at something and passionate and still have a dead end, right? The old example is the struggling artist. There are plenty of people who are fantastic artists, and they're extremely passionate. They spend all day and night in the streets of Paris painting and sculpting, but it doesn't make a dollar, right? That's our parents' fears for us. You need to make sure that it can make you a little bit of money, enough money. So what I always say about the money aspect is, again, you don't have to be a billionaire. Money is not the most important thing in the world. But what you should do as a basic rule of thumb is look out into the industry that, again, you are passionate about and you are proficient at, or you could become proficient at, and decide, is the top 20th percent of income worth it? Is that enough for me? Because with hard work alone, you can get into the top 20% of any industry. But certainly if you're proficient and passionate and you work hard, you will get to that top 20%. So is it enough? Is asset management, is the top 20% asset manager in the world, is that enough income for you? Then that checks the box of profit. Is the top 20th percent of real estate agents, is that enough for you? Great. That's all you need to think about. You don't have to chase millions. You don't have to be a one percenter. But you do want to make sure that there is at least a potential there. If you are very good at what you do and you climb the ladder and you put your 10,000 hours in, you want to know on the back end of that there's some actual profit to be made. So that's the third thing. My fourth thing that I add to this, I think is the real missing key that a lot of people don't consider. And I do talk a lot about two young men and talk a lot about the importance of doing things that make yourself proud of yourself, not comparing to others. Make yourself proud. This is a very, very important aspect. And so I always add purpose. Make sure what you're doing is not only helping you, but it is helping other people as well. Does the world need what you're doing? If it does, it's going to give you an extra boost above and beyond, because there are certainly ways to have all of these three. Not many people have these three, but there are people that have these that purpose doesn't apply. I'll give you an example. As we know, 85% of asset managers underperform their benchmark, right? You've heard of this statistic. Whether it's 80 or 90, who knows? Who cares? We know a large percentage of asset managers underperform their benchmark. They're not actually helping anybody. Their clients are not making anything above what they could do this in an index fund. Okay. Are they proficient at getting clients? Yes. Are they passionate? Probably. They're on Twitter. They love what they do. Great. Do they make money? For sure. There's plenty of asset managers that have all three of those that, look, they make tons of money. They've got big houses. They've got Audemars Piguet watches on their wrist. They're good to go. Do they have the fourth? No, they don't. So is that person truly going to be happy and content in life knowing that, well, yes, I drive a Lamborghini, but I actually haven't helped a single person outperform a benchmark? That's not going to be good enough for the fourth aspect of making yourself proud of yourself. So I would always encourage people to make sure that what you're doing is actually passion or purpose. Add the fourth P to the list, and you will be far better off. The purpose as well is very useful for getting yourself through difficult times. For example, for me, I don't mean to always bring it back to me, but I'm the only person I know intimately. So for me personally, I do go through periods where I struggle sometimes. I'm a very, very hard worker. I always say nobody's going to outwork me. If you work really hard, maybe you're tied, but nobody outworks me. And I've just been that way through my golf career and my investing career. But I even have struggles. I even have times where, I want to binge watch Netflix for 10 hours and just eat popcorn all day. But the purpose, understanding that I'm helping people, there are people relying on me to do my job, to come out next Monday with interesting stuff and make sure the portfolio is doing well. This purpose does get you through those difficult times. The passion, the purpose, sometimes the money, but you do need this fourth thing. And if you do that, there's you. This is where you sit in the middle of all of this, on the overlap of all of these. This is where you're at. And you need to custom design this. You need to go through it and understand that not everybody is suitable, but everybody has a way to do this. It doesn't matter what your education level is. This is the thing that drives me crazy all the time in this social media world is it seems like there's 2 or 3 jobs that people are chasing. Oh, you're not an asset manager? Well, okay, well then are you a real estate agent? No. Are you an influencer? No. Well then you're nothing. You're nothing. You can't make it work. You can't get ahead in this world. Is that true? There's thousands of jobs out there that check all these boxes. I'll give you an example of some of these. I mean, very short list, but of course, for me, I always default to what I do, asset management. I'm proficient at it. I mean, obviously that's for the audience to decide, but you want to be brutally honest with yourself when you're assessing these things. I think I'm proficient at what I do. I'm definitely passionate about it. I love it. I bounce out of bed in the morning, can't wait to get started, so that's good. I do make a good income, and the top percent of the asset management world makes a great income, so that's good. Purpose. I'm actually helping people. Again, it's for the audience to decide, but I think my track record speaks for itself. I've crushed all my benchmarks, and I will plan to continue doing that for another 20 years. So that's where I sit. Asset management checks the box for anybody. Like I said, you don't have to be a 1%er with the expensive home. The top 20% of asset management, that will do the trick. It really will. You don't have to be one of the ultra famous people you follow on Twitter, but honestly, roughly 10% of Americans make six figures, right? $100,000. Asset management is a high paying career, so probably it's 15 or 20, let's say 20. That's enough. You don't have to be a multimillionaire. Top 20% in the asset management world, good enough. So that checks the box. Real estate, the same thing. Are you proficient at real estate? It's a great career because there's really a very low barrier to entry. Anybody can just jump in and be a real estate agent. Put in your 10,000 hours. 3 years from now, you'll be a master and you'll be doing great. Are you passionate about it? Yes, it makes money. For sure, the top 20% of the real estate industry makes a good income. And purpose. Of course. Again, there is a way to do just these three. There is a way to just sell homes, to just churn them through, just get people herded through like cattle. But there is also a way to really dive deep and to really get personal with your clients and make sure that you understand their family dynamic and get them the house that their children are going to grow up with good memories at, and make sure that the commute to work isn't too arduous, and all these things. There is a way to add purpose to it and be a fantastic real estate agent while making a good income. The health industry, like I said, personal trainers, supplements and all that stuff. That's a great example of this as well. There's plenty of people who are awesome at selling supplements. They're passionate about it. They make tons of money, but they're selling snake oil. So they're not going to be proud of themselves. It's not going to, sustain them long term. You have to add the purpose. Are you really doing something good? Biotech companies don't have purpose. A lot of them are overtly intruding on our lives, right? So there are ways to screw this up along the way. But trade skills, again, you don't have to be one of the top 3 jobs and only an asset manager or only a real estate agent. Are you a good carpenter? Are you a good welder? Are you good with your hands? Electrician? Are you a good plumber? Yeah, if you're passionate about it and you're good at it, why wouldn't you be passionate about it? Being able to fix things like that, being able to weld properly, being able to build something with your hands, a nice piece of furniture, I would be passionate about that if I could do it. I can't do it, but I think that'd be a passionate career. Do they make money? Absolutely, they make money. What does the top 20% of plumbers make? Probably more than people think they do, to be honest. Trade skills pay. And do they have purpose? 100% they have purpose. If you come over and you fix something in my house that I'm, just fumbling around and can't fix it, that is absolutely doing me a service in my life. And I would pay you for it and I would thank you for it. And you'd be proud of yourself that you got me out of that. So there's all kinds of things. Teaching, social media, help people with that. It's a confusing place. There's lots of ways to make tons of money. Entrepreneurship, start a business, do all these things. Men's community. All right, I don't have a men's community, but hey, you don't need 1 million people to follow you. 1,000 true fans is all it takes. Start a men's community for $10 a month, have guest speakers, do live streams, help young men in this world who feel like they're forgotten. Nobody cares about their problems. Whenever a young man has an issue in his life, or, everybody, oh, you're just a man, what do you know? There's a lot of people who feel a little bit left behind. I don't like to compare the two. Obviously, being a young woman has its challenges as well, and I don't pretend to know anything about that, but it's not so easy to be a man in this world. It really isn't. And so, the men's community idea, you could do that too, and you could run with it and make it work. Another thing that I have to do personally, and maybe I would just end on this, is I also have to add my fifth bubble, which is lifestyle, right? So I actively designed my life the way it is. People might look at me like I'm going to Las Vegas tomorrow, but I'm still going to do a full workload when I get there. I'm still going to do my work. And then after Vegas, I'm going to Panama for a month. And I'm going to work just as hard. And if I didn't tell you where I'm going, you wouldn't even know. And then after Panama, I will probably go to Dubai in January. Well, why? Why am I doing this? Well, I wanted to do this. I'm a professional golfer of the past. I like to travel. I like to live in different places. So I had to actually add this and custom design my life. I had to ask myself, am I all of these things? Build my life and then make sure it's also conducive to being location independent. I have to do that because this is my perfect life. I'm not saying you have to do what I do. Moving around a lot isn't for everybody. Dreaming about living on a boat is certainly not for everybody. But the point is, you need to really put some serious thought into this. There are very few people. How many people are good at their job? Well, out of the entire population of the world, we just lost a bunch because, proficiency. People just went into something that they're either not good at or it wasn't really well suited for them. How many people love what they do? Now we lost a bunch more people. There's a lot of people working jobs that they really don't care about. Well, that is a mistake of choice, right? Certainly some environmental situations and some unfortunate realities of living in this tough world might come into play there. Not saying that everybody who doesn't enjoy their job made a mistake, but fewer and fewer people are in those boat. How many people make the money that they want to make? Like I said, 10% make six figures, but I think the median income for personal individual income in the US is about $36,000 a year. We just lost a bunch more people. How many people are in industries that give them personal pride that they're helping other people along the way? That's going to keep you going. That's a very important aspect of living a happy life. So how many people do get there? I don't know. But that's what I'm trying to encourage people to do here is that's what this mastery series is kind of about, that there are ways to separate yourself from the crowd, to really put a lot of thought into these things, some active decision making. Like I talked about with the VXX Decay and choosing my broken wing butterflies. I don't do this and just choose the trades. I calculate everything. I crunch the numbers. I make sure that every single trade that I am in has a reason to be in it. It fits into my portfolio, and I have a realistic expectation that I did my absolute best to put on that good trade. Same thing with building your life and your career. Same thing with finding a relationship. You don't just marry the first girl you see. You put thought into it. You make sure, you got to piece all these things together. So that's what this mastery series is about. Hopefully people appreciated a little bit of a rant on career choice because, this is, of course, not ever to be a comparison thing, but I'm 46 years old and I have found my place in the world, so to speak. Like I said, I hope it's conveyed on camera that I am actually content in what I do and I'm proud of what I do. And I work very hard because I'm passionate about it. And I know that I'm helping a lot of people. You can do it too. Whoever you are watching this, the proverbial you can do it. You really can. It's not going to be easy. It's dressed in overalls and it looks like work. Don't ever forget that. There is no quick fix. There's no get rich quick schemes. It's going to be hard. You're going to put 10,000 hours in. But 3 years from now, you can do anything you want. It's not as daunting as people think it is. If you're 60, when you're 63, you could be making six figures selling real estate on your own schedule, no boss, making videos, going to locations and walking clients through virtual videos. And you could be doing fantastic. It's never too late. And it's extremely hard. But on the other hand, it's actually very achievable. So good luck to everybody. I know you're going to do it. You're going to find your passion in life. And it's all going to be worth it. It really is. So, how long did I go for? Too long. Too long. I don't know. Maybe I'll go back down to one segment. If I feel like it's going to be really long, maybe I'll go to one segment and then the Q&A. But let's get into some of these questions. Thank you. So first of all, again, quick reminder, thumbs up. I hate to ask, but do it. Do it now. Thumbs down if you want. There's 3 of them. That's the most thumbs down I think I've had in a while. Somebody doesn't like me. Again, though, don't watch me if you don't like me. I mean, if you don't like me, it's fine. But what are you doing with your life? I don't watch people I don't like. I don't have the time to give somebody a thumbs down. I just politely leave. I don't say anything. I don't make it a big deal. I don't announce I'm out of here. I'm never giving you any business again. Just leave. It's fine. There's plenty of other things that you could be doing with your time. So, but thumbs down are good because it is actually good positive engagement for the YouTube algorithm. So I appreciate that. Sometimes even the people that do the best are the people that have like a lot of haters. They get a lot of views because YouTube prioritizes conflict. So, and maybe a few more of you just smash that thumbs down button for me. Let's make YouTube think I'm some radical, making outlandish claims here. That'd be funny. Okay. I don't understand why my margin requirement on IB is the same for normal ETF and leveraged 2 times ETF. Is that normal? Thank you. Yes, that is normal. I also notice the same thing. I use Interactive Brokers for my long-term portfolio. It's the same. I can confirm what you're saying. Now, there are ETFs that have large, for example, SVXY is going to be a large margin ETF, but that's because of a regulatory reason for it. But that's different. But you can see that this MVV position, for example, it's actually, let's get the exact numbers here. 907 times, I got in for 64,699. This is a $58,600 position, but the breakpoint effect is 26,000. So let's just say half. It's just a little bit different, 40 something, whatever. But let's just say half. But they're all kind of the same. Now, the reason that this one is lower for the SSO is because it's a smaller position. The QLD and the MVV are a little bit bigger right now. But if I were to switch MVV for MDY, it would be the same 26,000, as long as I scaled it to the 58,000 allocation. QLD would be the same. Going to the straight QQQ, it'd be the same allocation for me. Now, I can't say for sure, I should preface this, I can't say for sure that that's the case in yours. I have 0 restrictions in my account. I have nothing but international accounts, nothing but margin accounts, with no restrictions at all. I can't say for sure if you looked at my live stream and then you looked at your account, hey, what's he talking about? My margin? I don't know. It is certainly possible that different people, their brokers are treating things differently. That is possible. But you're correct. Yeah, at least that's my experience as well, is that whether you're trading the 2 or 3 times ETFs or the standard ones, it's not going to change your margin allocations. Now, for me, I don't ever actually utilize all of that extra margin, so it doesn't matter for me. But yeah, on a technical basis, you're probably right for most people. Can't say all. I don't know. Why does not everyone just sell a deep in the money put to buy stocks? Well, this is a deeper question than you probably think, but let's look at what you're saying. So the thing about selling deep in the money puts, it doesn't actually reduce your risk. This is the one thing that kind of you'll hear a lot of people say is, hey, if I'm going to do it anyway, I might as well bring in a little bit of premium and sell the deep in the money put. So let's say I wanted to buy the SPY. It really stops working really deep in the money. So let's go to at the money, the 468. If you do it at the money, if you sell the put, right? If you sell it at the money, you're going to bring in a nice premium. But of course, that's a risky trade because it's at the money and it could go way against you. Now, you will bring in a little bit of premium. However, when you sell that contract, it will scale to the price dropping on you. So this is not a risk-free trade. There's a lot of people who think that, well, I was going to do it anyway. Yeah, maybe you were going to do it anyway, but you're still going to lose a whole bunch of money if the stock market crashes. That contract is going to be very bad for you. And of course, it's going to be a short Vega trade, so it might even actually end up being worse. But what you'll notice is the further in the money you go, the less of a benefit you will start to get. And at that point, it's just scaling pretty close to 1-to-1 once you start getting the delta low enough. It's pretty 1-to-1. So it's one of those things where you could do it, with very little benefit and it would be a much safer trade, or you could do it with a lot more risk. Basically, you're not changing the risk profile of the trade, and then there's more risk, more payout. It's not as simple as just saying, well, I was going to do that anyway. I've always planned to do a full video talking about this because it's a hard thing to explain. But if you're doing anything in the options world where you are still subject to nearly all of the losses, but you're not actually reducing your risk very much or hardly any in some cases, you'll get some people say, well, why don't I just sell $100 VXX naked call? Like, it's never going to get there. If you're still subject to all of the losses, which you would be on a naked UVXY call way, way out of the money, if it goes up, you're still subject, and options move moment to moment. You don't have to wait for expiration to be losing all your money. It moves moment to moment. Selling puts on SPY, same thing. You are still subject to the crash of this S&P 500, but where's the upside, right? Maybe you'll make $5, but what if the S&P goes up on you? What if it goes up a lot? Well, you only made $5. So you're basically capping your gain, but you're not really doing a whole lot with your downside risk, are you? I mean, really, at the end of the day, $5, $10 premium on a $450 ETF is really not making a whole lot of impact. And then if you go really deep in the money, you're getting hardly anything. You're just going to get pennies. So it's just a trade that sounds great when you first hear about it, but certainly asking me, I don't do that. And what you'll notice is if you ask a lot of very experienced option traders, that's not something that they do very often, if at all. I mean, I have a strategy that's kind of based on that. It's called the Wheel of Fun, where you sell the puts, and then if you get assigned, you kind of want to get assigned, and then you sell a super aggressive covered call and dump the shares as quick as you can. But that's a premium strategy. It's not based on price at all. But most seasoned option traders don't do these types of things. They just don't. Because again, you're capping your gains. You're not changing the downside risk enough to make it worthwhile. So not great. And it's the same thing with people who say, I'll just keep going further, selling naked calls on volatility ETPs, sell a naked call on VXX or UVXY. Well, you've capped your gain, all right, because you can only ever make the premium that you sold for. And it's typically not that impressive, right? You might make 3 or 4% on a weekly contract if you're super aggressive, or 5% on a monthly. It's not that impressive, but you're still subject to all the losses. So why would you do that? Why would you churn a naked option on a volatility ETP knowing that if it goes perfectly for you, you're only going to make 5%? If it goes very badly, you could lose hundreds of percent. Who does this, right? Only the most inexperienced traders do this. I know they get views on Twitter, but nobody with an understanding of risk reward actually does this, because you are capping your benefit. Where's the reduction of risk? There isn't any. So no, that is a very poor decision to make long term. Now, you might get away with it once or twice. You might get away with it for 2 months, but eventually, if you are in the habit of selling things that cap your gains and don't reduce your losses, well, guess what? 10 years from now, you're going to be that person I told you about that thinks they're doing great, back to square one. Thinks they're doing great, back to square one. That's what's going to happen to you. So you want to look for things where you can get the maximum amount of capital into the trade so that the upside is there, and look for ways to reduce the risk so you're not going to get blown up. That's the key to long-term success. It's not, let's do this and let's just see how many weeks we can go without it going against me. That's just dumb. Quite frankly, that's just dumb trading. That's just what people do to get eyeballs on Twitter. No profitable traders do that. Okay, a therapy again from me on this evening in Germany. Evening in Germany. Yeah, I think I'm going to actually try to do different times as well. When I'm in Vegas, I don't know, should I do an evening stream? See if more people can tune in. Do you know the YouTube married couple, Stefan and Todd? Yeah, I know Stefan James from Project Life Mastery. I do. They're from Vancouver and live there in Panama. Yeah, I've seen him around. I know who he is. I'm in Vancouver now. Yeah, he's good. I like him. I have nothing against Tatiana, but I started following when he was just doing his own thing. And yeah, good stuff. If anybody, I don't mind giving recommendations. Not all of it's for me. I mean, a lot of it is, obviously he's selling something. So you want to dip a toe and see if you like what he's all about. But yes, he's basically doing what, not what I do, not even close to what I do, but it's sort of a community for entrepreneurs and motivational stuff and how to start businesses. And, there was a time in my life where I thought I might actually get into that as well. Like I said, let's go back to the original presentation. That type of thing, it's not specifically, maybe Stefan is kind of combining two or three things here, but it does check the boxes, especially if there's purpose. If you're just selling stuff and just using very predatory marketing techniques to make people buy courses that when they get it, on their computer, it's just not worth anything at all to them, then you're in a situation where you're here, right? You're not going to be proud of yourself, but you can still make money doing that. From what I can tell, and I don't know, I've never paid him a single dollar, I've never bought anything he has for sale, but from what I can tell, at the very least, he thinks he's helping people. And so I like that. I like people who make your money. I want you to make your money. Go for it. I'm not one of those people that are jealous of others who make money, or I want all of you. Go make your money. Don't lie. Don't deceive people. Focus on the purpose. Focus on the process. And good recommendation. Go follow Project Life Mastery. I didn't recommend buying anything, however. You're going to have to assess that for yourself. But should VTS be used with other asset allocation strategies, or is VTS an entire portfolio and there is no need to use other allocation strategies in addition to VTS to diversify an overall portfolio? Good question. I can't really give you an answer that I think you're looking for because I can't ever address anybody's personal investing situation. But what I can say is this is all I do. I don't have my capital in any other places other than my own strategies. So while I can't tell you what to do specifically, I can certainly say that for me, I have built a very successful, diversified portfolio of strategies that work very well together to the point where I don't need anything else. Now, of course, I will mention that I typically will invest somewhere around, it depends. My option trading depends, but let's say 30%, maybe sometimes as high as 40, but let's say ballpark 30. I do a lot of option trading as well. And so 30% of my portfolio will be sort of the VTS options type of stuff. But the VTS portfolio, as I've designed it, is good enough for me to be fully diversified and to not suffer the drawdowns that, like I'm telling you, losses are more costly than gains are beneficial. Drawdown reduction is paramount in investing. Don't listen to people who are always chasing shiny objects. It is about boring, stable drawdown reduction, but it gets me to what I need to go. And I've been making really good progress over my 15, 16-year career. I plan to continue that way. What I will say, though, is there would be nothing wrong with using what I do as the core of your portfolio, because it's up for the audience to decide always. But if I'm honest with myself, I've created something pretty good. And to act as the core of your portfolio, that would be fine. And then if you wanted to diversify to other people, that would be fine as well. There would be nothing wrong with, I always say nobody puts all their money in stocks, but a 60-40 portfolio, the reason 60-40 makes more sense than all stocks is for that reason. You need the core. Stocks do trend up over time. You don't want to, avoid the good stuff, right? And if I can be presumptuous, VTS is good. So use that as the core and it's fine. If you wanted to add something to it, no problem at all. The problem is I can't actually help you with that because everything I do is hyper-focused on calculating correlations and beta factors, and I go through a lot of things to allocate my portfolio correctly. So if you're doing something else on your own, you're never really going to know how that interacts with the portfolio. And remember, the most important time to know these things, how everything reacts in relation to each other, is during crashes. You want to make sure that you're not just every time my portfolio has a weakness, what you did is also a weakness, or maybe even a bigger weakness. That wouldn't be adding diversification. So unfortunately, I can't help you because I don't know your personal situation. But generally speaking, with no recommendations here, what I have built is a standalone portfolio designed for both profit during bull markets and tail risk during recessions. And that's what we've done, live trading, performance-wise. There would be nothing wrong with adding something to that. I see nothing wrong with that. Again, all of my warnings, though, of all of the, let's just say it, charlatans out there, make sure that the other that you're looking at is also a little bit boring. Like when people hear me do my live streams, I'm under no illusion that people out there, they're having, drinking parties and ordering pizza to make sure that they tune into my live stream. The stuff I talk about is not thrilling, but it's going to get you to where you want to go. I know that. So make sure the other, Jim, is also a well-selected other. And then I think you should be fine. A lot of good people out there. My method of investing is certainly not the only way to do it. It's worked very well for me. I think it works very well for my followers. It's far from the only way to make money. So find somebody good and, hey, mix it up. It's fine. Is there an alternative to VXX crush level metrics to pick the right strike price and expiration date? I usually go for implied volatility and roll yield, but I'm certainly... Okay, good. That leads me to a little bit of a teaser for you here. This is, of course, VTS community specific. So what I talked about is what my community gets access to every day, is that the actual crush level based on today's metrics. So it's weekend right now, but this is based on Friday's close. This is where we're expecting Monday to be. Now, Monday could be Volmageddon for all I know. But again, when you're investing, it's all about probabilities and what's most likely to happen. And what's most likely to happen Monday is probably going to look very similar to Friday, statistically speaking, within, a standard deviation or so. What happened Friday is probably very close to what happens Monday. Don't be a contrarian in this industry. It might, contrarian works long term. It does not work day to day at all. So this is specific to VTS. But what I will do for you is in a future live stream, I'm going to do the exact same analysis, all of the stuff that I did for the VXX crush level, how I personally use it to price out trades. If you want, I can put something together using the VIX futures, because certainly for the VIX futures, everybody has access to this. You don't need to join the VTS community to access the VIX futures. You could also do it if you wanted to be, even better at it, like you alluded to. I think the roll yield obviously is a far more meaningful number because the volatility ETPs don't actually trade based on M1 and M2. A lot of people think, oh, it's upward sloping, it's contango. That means the VXX is going to decay. Well, it doesn't. It really doesn't. What you're really looking for is the relationship between these futures and the VIX index and the number of days to expiration. You have to calculate all of that, and that's when you get the VX30 to VIX roll yield. So this would be a more meaningful way to go about it. What did you say? You mentioned two methods. What was the second one? You mentioned roll yield and go for implied volatility, meaning, I don't know. I mean, implied volatility could mean many different things, but you're on the right track. If you don't have the VXX crush level metric calculated for yourself and you're not a member of my community, then default to that roll yield, that VX30 to VIX roll yield. And you could do a very similar, maybe not as meaningful, maybe not as robust, but definitely good enough to get you that edge that you're looking for. Remember, the options market is a highly competitive place. Just based on the fact that you're asking this question, I suspect you're already way ahead of the game and you do actually have a pretty decent edge. If you even know what you're looking for here, you're already ahead of the game. So I would use the roll yield, come back to this live stream and try to piece it all together and do it yourself. That'd be fine. Or wait, and I'll do another one in the future for a more general audience of using roll yield. Might be a good one. Yep. I always like to take pictures of the good questions. Store that for later. Thanks for the suggestion. All right. What time is it? Uh-oh. Hour 9. We should probably look to wrap it up. All right. You do some truly impressive work avoiding the big drawdowns by crunching the numbers. What else than numbers, such as macro or geopolitics, do you use as input? Zero. I've done several videos talking about that. Zero. Because it is completely unpredictable. It is so uncertain because, actually, this isn't exactly specific to what you're asking, but this is a good video for you to watch. I think you'll like this one. Ignore the title. It's not actually a political video, but what did I call it? I remember I did some clickbait thing. Double uncertainty. And I used the Biden-Trump election as the backdrop. But go ahead and watch this video because I am talking about what I call the double uncertainty of investing. Now, numbers are always accurate, so always default to the numbers. But what I mean by the double uncertainty, if you're going to be the type of person that is relying on macro or geopolitics or something like that, let me use the election. Apologies, I'm not a political person. I'm an equal opportunity offender. I hate both political parties in the U.S. pretty equally, to be honest. I think they're all on the same team, and they're all just enhancing themselves. I always have this image in my head that, Nancy Pelosi and Donald Trump are drinking scotch together somewhere, just laughing at the whole thing. Hillary Clinton's in there with, pick your Mitch McConnell. They're all friends. They're all on the same team. So I'm not making a political statement here, but the Biden-Trump election, at that time, there were a lot of people who had that idea that, if Biden wins, the market's going to do this. And if Trump wins, it's certainly going to do this. We did the same thing with, Hillary versus Trump the first time around. Sorry, it's not Biden. Anyway, I'm getting my things mixed up here. But the double uncertainty is not only do you not know the outcome, right? We don't know who's actually going to win the election. So making trade decisions based on an uncertainty of not knowing the actual result is, of course, going to lead to less robust results. Sometimes it'll work. You'll nail it and you'll get it and it's going to be good. But long term, on average, less robust. But the second uncertainty is, even if you correctly predict what's going to happen, you still don't know how the market's going to react to it. You might think Biden's going to win and markets are going to crash. Maybe you thought that. Okay, you were right. Biden won. But the markets didn't crash, did they? You might have thought, oh, wow, if Donald Trump wins, it's going to be the end of the world. I'm going to predict that Donald Trump wins, and when he does, markets are going to crash, so I'm going to short the S&P. Well, he did win, so you got that right. But the markets didn't crash. They were limit down that night. It was looking pretty scary, but by the next day, they closed green, and then it went on one of the most impressive runs in modern history. So you would have been wrong there. That's the double uncertainty. Earnings events are the same thing, where you don't know what the earnings outcome is going to be. But even if you do, you don't know how the market's going to react to it. Sometimes a good earnings report leads to a sell-off. And sometimes a good earnings report leads to a spike in the stock. Sometimes a bad earnings report leads to a terrible result and the stock crashes. Sometimes a really bad earnings report is bought for some reason. The stock goes up. There's always double uncertainty. So you can never, with any reasonable accuracy, weigh these things and make money long term. Now, again, I don't like to state too many opinions. I think this is a mostly factual statement I just made. I'm sure there are certain people out there that have done very well using macro, but in general, just go look at the results of macro hedge funds. There's your answer. It's just too uncertain. There's always the double uncertainty. It's not only predicting the outcome, it's predicting the outcome of the outcome, which is just, layers of I can't do it. So I like to stick to only the numbers, and it's always served me well. I don't use any. If next week there's talk of a war or something, that's not going to factor into my trade decisions. If we're coming up to the election and it's a few weeks out, I'm not going to change my portfolio based on, what was that website that used to track the election numbers? Like if the blue line is going higher than the red line, I'm going to adjust my portfolio. I don't do any of that. It's just stick to the numbers. My analysis, while this is not This is not all of what I do. These are just the things that I've shared so far. But this is what my day-to-day looks like. This is my trade decision, not who wins the election and what it will mean for the economy. It's, do I want to be holding VXX knowing that right now it's decaying minus 0.54%? No, I don't. I don't want to be long vol right now because that would be a mathematically bad decision to be in. Volatility barometer, it's fairly low. It's in the lower third now. That is historically a good time to be long equities and short vol. So what am I? Well, I don't care what the world is doing. I don't care what I read on Twitter. I'm long equities and short vol because the numbers tell me to be. The math, the history, the data mining, it all tells me everything I need to know. I don't need to take geopolitics into consideration because I'm no better at it than any of you are. We're going to get it wrong 50% of the time. I'm not good at predicting elections either, and I'm not good at predicting the outcome of the prediction. So, no thanks. Just gonna, numbers don't lie. What is that Jay-Z quote? Numbers don't lie. Something about girls. I'll leave that out. But yeah, numbers don't lie. Leonard 862 had a question above on variance risk premium harvesting with short strangles. There are times when my software doesn't show the same questions as what you guys see. For some reason, I'm using Ecamm Live software, and every live stream that I do, somebody will email me later, or 5 people will email me later and say, you skipped my question. What was wrong with my question? There's nothing wrong with your question. My software just didn't show it to me. I'm going top to bottom of what I can see. And then whenever I go back and edit it and I timestamp and I arrange all the questions that were asked, I can see, oh, there was one and there was one. So I'm not skipping anything, trust me. I don't see anything. The only one I see from that name was this one that I answered. Apologies. I'm going to have to wait for the re-edit. And if it's important enough, sounds geeky enough, might be interesting. Variance risk premium harvesting. I'm in. I'll look for that when I'm editing. I don't typically do these. UVXY price predictions if crash. Well, you'll want to have the data first of all. So this is the UVXY on a log scale, simulated back to 2004 and using 1.5 times leverage factor. Because remember, on February 27th, 2018, the SVXY and UVXY deleveraged, and SVXY, of course, went from -1 to -0.5, and the UVXY went from 2. It used to be the same as the old TVIX, and then it went to 1.5. So first of all, you need the data. You need to get your hands on this data. And then what you can do, maybe this will make a good live stream, so thanks for the tip. You can start to calculate exactly, what we can expect for certain size of crashes. So you can see, I do all this stuff behind the scenes. I couldn't possibly share it. But how often does UVXY crash more than -5%? How much does it go down? How often, right? And then I've also got how often does it go over 5%? Over 10, over 25. How far did I go? Over 50. How many times did the UVXY go over 50% in one day? Well, there's the answer, 3 times. 0.07% of the time. How many times does it go more than that, right? So this is just 5%. Well, I probably, knowing myself, I haven't looked at this in ages, but I probably did more. This is over a 5-day period. How often does the UVXY crash more than -25% over 5-day periods? 54 times, or 1.28% of the time. I have all these numbers. I don't know how. Let me look for the bigger ones. Over a 21-day period. How many times? Because your question was price predictions in a spike. So the UVXY went over 500% over a 1-month period, remember 21 trading days, 5 times. 5 times in its 17-year simulated history, it crashed over 50. How many times did it go over 25%? Quite often, 386. 10% of the time it goes over 25%. So, given these numbers on the fly, price predictions if crash. I'm not sure if you mean if the UVXY crashes or if the market crashes, what does the UVXY do? I assumed you meant if the market crashes, where does the UVXY get to? Well, if the S&P 500 crashes significantly, like we're talking within the top 5 or 6 crashes, the pandemic, the financial crisis, the dot-com bubble, number 4 was, I guess, if you go back to 1987, that was a big one. If you go back to 2015, August 2011, Q4 2020, one of those, you're looking at the numbers that I showed, that there are times when it'll go over 100% in a 21-day period. So yeah, the UVXY will certainly double, and it can go much higher than that. It can go 5, 6, 700% in a few weeks, in a short period of time, in a few days, technically. I mean, October 1987, the reason people don't talk about it anymore is because the VIX index data only goes back to 1990. But if we use the VXO calculation, which used the S&P 100 instead of the standard right now, the 500, the VIX would have gone over 150. It would have gone to 172 intraday. So how high could UVXY go? As high as your imagination will take it. That's the answer. So don't ever be short those calls, those naked calls. Now that I'm looking back at that old spreadsheet, though, maybe that would make a good live stream as well. Maybe we could go over some of these numbers, because I've got all the data. I'm not ever really sure if people will be interested in me sharing everything I have. You can see my spreadsheet's beach balling here because I've got 100 pages that look just like this one. I've just got data for everything, and I've got 6 different spreadsheets that beach ball on me as well. It's really annoying. I do more work than my computer can handle, apparently. An intelligent question. Presumptuous of you. I will be deciding that. Suppose VIX today is at 17 and 30 days out, VIX future is at 21. So the VIX is at 17 today and 30 days out, the VIX future is at 21. I think that's more or less accurate to the current situation. 1 month out, yeah, it's at 2070. So you are correct there. Tomorrow, the spot VIX is the same at 17. But 30 days out is at 23. What predictive power this has? Well, no predictive power. That would be just what happened. But if that were to happen, the volatility ETPs would go up, right? Doesn't matter if it's in contango or not. The volatility ETPs get their pricing based on the constant changing values of the front 2 months of the VIX futures. That's it. So even if it's in contango, as you're explaining here, it shifted up from 21 to 23. There would have been a shift upwards in the VIX futures. It would probably still remain in perfect contango. The number itself would be the same, contango-wise, but the VXX would have gone up that day. That's what would have happened. As far as predictive power, you're talking about the day after, like it went from 21 to 23, and then what does it mean? I would say nothing. I would say on its own, that means nothing. You would want to, if you knew why it went from 21 to 23, that might be predictive, because like I said, a very good baseline assumption for investors is what's going to happen tomorrow will be very similar to what happened today. What happened today probably looks a lot like what happened yesterday. That's just statistically, if you do a Bell distribution, that's what you're going to find, is that trend following just makes the most sense. It might make less sense on a long-term time horizon, but your question is certainly very short-term. So I would say the only predictive power you'd be looking at there is if you knew why it went from 21 to 23. If you metrics were breaking down, let's say the contango did drop. Let's say the roll yield did go down. In this case, it might actually go up. But let's say that your metrics themselves were starting to show signs of breaking down. that might start moving you across the risk curve. For example, if that were to happen, using your current example, as of last Friday, for example, I am in a long VXX put option, basically short vol. If that were to happen, well, this trade dial might go up a little bit. Now, if you used a more extreme example, like it went from 21 to 30, obviously the front month contract and the back month would go up quite a bit. But if that was the case, I'm only concerned if this trade dial goes above this line, right? I'm only moving out of the SPY if I have a reason to get into real estate. I'm only actually going to exit my S&P 400 mid cap and go to safety bonds if I have a reason to do that. The VIX futures ticking upwards slightly, that's not going to kick me out. So, and it wouldn't be predictive of anything. But if you started to notice that everything here is kind of going from green to yellow, then yes, you might be onto something. There might actually start to become a little bit of predictive power there. I should have finished your question. Do we expect the VIX curve to keep shifting upward? Do we expect the spot VIX to spike in the next days? Or as it seems many times is the opposite, the curve shifts down and the spot decreases? Well, a move from 21 to 23 is fairly normal. It would be abnormal if the front month didn't move and the back month did, but I think your question is a normal day-to-day. I wouldn't think anything of it, I don't think. But you're right. Most short-term spikes, if you want to call it that, they do get faded. You want to be careful because when they don't, sometimes they really don't, and you want to price accordingly. But yeah, see if there's some more questions here. I think we should wrap it up, actually. I might go for a run and then pack, and then I'm off to Las Vegas. I haven't been to Vegas in... I used to play golf tournaments a lot in Arizona and Nevada, so maybe back in 2005, I spent some time there. Yeah, I think the last time I was in Vegas was for a golf tournament, so that is 17 years ago when I retired from golf. So I'll let everybody know. I'm going to take my camera, and I'm going to do a live stream from the hotel room in Vegas, where we're staying in the Palazzo, the Venetian Palazzo or whatever it is. So, yeah, thanks everybody. Hopefully you gained a little bit of value. And like I said, I am going to be experimenting with some of these segments that I have in mind, like try to create more of a show for everybody. So today we did the Data Corner. Hopefully people liked that. And the Mastery Series, actively taking the reins and really being the determining factor of your future career path, rather than just falling into something and then realizing 20 years later, maybe I wasn't suited, or maybe I wasn't really passionate about it, or maybe it doesn't really help anybody but my bank account, and that doesn't make me happy. So, maybe there was some value there as well. Leave some feedback. I do answer comments. Thank you very much, and I'll see you in a few days, live from Las Vegas.